Hi, thanks for being here. I hope you're getting value out of these mortgage market updates. Before we start today, I've got a question for you. When you have a file that starts to go sideways, do you find yourself stuck in a queue waiting on an underwriter 3 or 4 states away to get back to you? And when they do you feel more like they just want to get your file off their desk than to help you get it to the finish line? Well, Central Coast Lending's not built that way. We're a small, independent correspondent lender, and you have direct access to your underwriter. They get paid by helping you close loans, so they're invested with you. When you've got a trickier file, you pick up the phone and you call Jason or Dan. They're the owners. They will help you solve the complicated issues and get to the closing table. If this is a model that sounds well suited for the way that you run your business, I'd really like to talk to you. My contact information will be on the screen at the end of today's update. So with that, let's get to it.
Good morning. This is your mortgage market briefing. The big story heading into Tuesday is that mortgage rates are still elevated, but the bond market showed a little bit of stabilization before the holiday weekend. Mortgage News Daily had the 30-year fixed at 6.65% on Friday, flat from Thursday, after rates briefly pushed as high as 6.75% earlier last week. Freddie Mac's weekly survey showed the 30-year fixed at 6.51%, up from 6.36% the week before. So the message is simple. Rates are not running away, but they are still sitting in a higher, more sensitive range. The insider angle is in the MBS market. The UMBS 5.5 coupon closed Friday at 99 and 26/32, up 3 ticks on the day. That is modestly positive, but not enough to create a major improvement in rate sheets. In plain English, mortgage bonds caught a bid, but they did not break out. That is why borrowers may see pricing feel a little better than the worst point last week, but not dramatically better. Lenders are still cautious because volatility is high, and when MBS prices move around, rate sheets can change quickly. The 10-year Treasury was around the mid 4.5% range late last week, with Fred showing 4.57% on May 21st. That remains the key level to watch. If the 10-year moves back toward 4.65% or higher, mortgage rates could feel pressure again. If it breaks lower, we may get some relief. For loan officers and realtor partners, the practical talking point is this. Buyers should not be trying to time the perfect rate. They should be looking at payment, inventory, concessions, and strategy. Higher rates have slowed some buyers down, but that also means less competition and more room to negotiate in certain situations. MBA's latest survey showed mortgage applications down 2.3% and ARM activity near 10% of applications, the highest share since October 2025. That tells us borrowers are actively looking for payment relief and creative structure. This week's market calendar starts Tuesday with consumer confidence, the Philadelphia Fed non-manufacturing survey, and Dallas Fed manufacturing. Wednesday brings new home sales. These reports matter because the market is watching for anything that changes the inflation, growth, or Fed outlook. Bottom line, the bond market gave us a little breathing room, but not a green light. This is still a lock carefully, structure smartly, and communicate early environment. For buyers, the opportunity is not just the rate, it is the full deal. Price, payment, credits, buy-downs, and future refinance flexibility. And for realtors, this is a great week to re-engage buyers who paused. The market did not suddenly get easy, but it may have gotten more negotiable.
That's the update for today. I hope you get value out of these.